This morning, billionaire Mark Cuban weighing in on the Inflation Reduction Act, tweeting, quote, while buybacks are everything wrong with what companies do, the decision to place a levy on them is the top of the list of bad taxes. Joining us now is Republican Congressman French Hill of Arkansas. He's a member of the Financial Services Committee and says the provision could be detrimental to business. Good morning to you, Congressman. I should also say, if I were to continue on with those tweets, it's a little unclear what Mark Cuban really thinks, because at one point he says maybe the tax should be 2%.
Well, it's good to be with you, Andrew. I think it's bad policy by the federal government to tax stock buybacks because I think it hurts ordinary investors, and it preempts the board's fiduciary responsibility to measure growth and the use of capital to grow the company, and from time to time to take the advantage in a very effective way for shareholders to buy their stock back if it's significantly below their own calculated intrinsic value. This is smart finance to do that, and this is the government mandating essentially that it not be done by placing an excise tax on it. And I think it's just wrong for the government to do that. But this is a Bernie Sanders idea that's found its way into the Biden agenda and also into the SEC's agenda, as they have a rulemaking to try to make it more difficult to do stock buybacks as well.
Well, Congressman, I want to dig in on buybacks in 1 second, but it's worth putting some context around this, that this became effectively a replacement, if you will, to raise revenue for the fact that there was a provision that would have closed what we all have talked about on this show many times as the carried interest loophole. Would have you been in favor of closing that?
You know, I wouldn't have been, because I do think under the right circumstances that carried interest, if it's done properly, should receive capital gains type treatment. But I hear you, and I think you asked the right question. You've gone from a potential Democratic idea to raise revenue from the proponents and institutional shareholders related to private equity transactions, and instead imposed a tax on labor union pension plans and 401k participants, everyone who invests in the market, who has a board of directors alert to ways to improve their long-term return without damaging growth when their stock price is out of line with where it should be properly valued.
Congressman, let me ask you this as a policy question. I think there's a fair argument to be made that over the years, if you were to look at buybacks broadly, they have been an overused tool that has been, in some cases, used to goose compensation. They've been used in context to goose stock prices. It hasn't worked. I mean, there's been a lot of wasted money over the years, buybacks, if you were to look at the total use case of them. The question, therefore, is there anything from a policy perspective that should be done to try to limit them at all?
Well, Andrew, again, you ask a good question, but I go back to Warren Buffett's maxim about stock buybacks, that if you can buy dollars for 80 cents, isn't that in the fiduciary interest of all shareholders and a good decision by the board? Which is not to say that if management shouldn't be warned that if they imprudently buy stock back, paying too much of a price, they destroy capital, they destroy the growth prospects for the company, and they ought to be punished by the analysts, the owners, and the broad shareholder base of that company.
Congressman, so I don't disagree with you, but I think the issue is that we have effectively incentivized buybacks and effectively disincentivized dividending out shares dividending out shares to investors, for example. So right now, a dividend is disincentivized on a relative basis to a buyback. I don't know if you think they're comparable at all.
Well, look, companies, we've authorized buybacks more broadly since about 1982, and the return to shareholders over that time between dividends and cash buybacks has basically stayed in the same range. Companies have to decide within their industry and within their shareholder competitive environment what's better, a growing long-term dividend or occasionally using stock buybacks when their stock price indicates that it should be used. It's not a routine thing unless the company is perpetually undervalued to that intrinsic value. I still think, despite the tax disadvantage of dividends, that long-term dividend performance is something that's valued by shareholders, certainly by income investors, and therefore they both are very good capital return mechanisms for shareholders, and shareholders benefit small and large.